Right, let's take a quick look at the metals this weekend. I noted this trend line, the intermediate trend line in past videos. On Thursday, we finally got a close below that trend line. On Friday, uh, an attempt was made to recover the trend line, but it did not succeed, and price is still below that intermediate trend line. Um, this doesn't make me extremely bullish. I know a lot of people are viewing this consolidation as as some kind of a triangle consolidation that's going to uh, eventually break higher, very similar to this consolidation here. And I would be in that camp too if it was just occurring earlier than in the intermediate cycle. Back here we were between week, I believe, 7 and 10 or 12, something like that. And that consolidation, I think, had high odds of breaking higher, and of course it did. Now we're on to week 25, and sentiment has been embedded in the excessive optimism levels for a long time during this intermediate rally. Um, at 25 weeks into an intermediate cycle, this is more likely, in my view, is more likely a distribution pattern than an accumulation pattern like this was. And now we've got, some warning bells starting to go off. Again, a close below the intermediate trend line. It was not able to recover here. And then another thing that has me very nervous, especially this many weeks into an intermediate rally, is that there's just a lot of white space between where price is at here and this 200-week moving average. Let me widen the chart out, and you can see that we're stretched abnormally far above the moving average. All right, so this is a pretty good chart to show this. You can see, and all markets tend to, over time, tend to regress to the mean. The one time where they don't really do that, or at least they take a long time to do it, is when an asset is in a bubble. Then it can just keep going and going for a long time. Eventually, it does regress to the mean, and when that happens, when the bubble bursts, then it goes far below the mean, and then you're stuck in a bear market for many years. I don't think that's the case with gold right here, but as you can see, we at this top here at almost 2100, we were just stretched very, very far above this is the 200-day moving average, so abnormally stretched above the long-term moving average. And we're going to need either, at this point, I don't think this is, as I said, I don't think this is an accumulation pattern that's going to just blast off and go higher. For that to happen, I think we would have to be starting the bubble phase in gold, and I think it's too early for that. So two things are most likely to happen here. Either price can just churn sideways for, realistically, it's going to take probably 2 or 3 more months for this moving average to kind of catch up to price, very similar to what happened here. This took almost 3 months for this kind of a sideways churn to give the 200-day moving average some time to kind of catch up to price. So, and we're stretched even further at this peak. So we're either going to have to consolidate sideways for another probably 2 months to allow this moving average some more time to catch up to price, or we're going to have to have a sharp move back down that fills some of this gap. Even now, even after we've been churning sideways for a month and a half, there's just still too much white space between price and this 200-day moving average. My expectation is I think it's more likely that we're going to break down out of this consolidation, break lower, and maybe come back down to test 1800 or this T1 midpoint consolidation here around 1750 is a potential target as well. I think that's probably more likely the scenario ahead, and especially if we have some kind of a little mini crash in the stock market, it's going to create a deflationary scare. We'll probably get a spike in the dollar, very similar to what happened here when stocks collapsed and we had the deflationary scare and the big spike in the dollar, and it took everything down with it, including gold. I don't think we'd have as bad of a crash in the stock market this time, but the NASDAQ especially is, you think this is stretched far above the moving average. The NASDAQ has just gotten ridiculous, and it is set up for some kind of a mini crash event, possibly over the next few weeks, unless it is in a bubble, in which case then it'll find its footing here and just take off again. But I kind of think that's unlikely as we head into the election. So I think there's risk of stocks giving us some kind of a deflationary scare, and ultimately that infecting the metals briefly as well. Will come back down, close some of this gap here between the moving average. That'll reverse sentiment. People will get bearish. We'll wipe out this extreme optimism that has been in the metals market for months now. We'll reverse that. Everybody will start to get bearish. A lot of talk about deflation, and then I think that would be the fuel for the next leg up. And I think the next leg up would give us a sustained breakout above not only 1923, the old high, but also above 2000. I think we would have a sustained breakout above that and not come back below it any time in the near future anyway. And then finally, to end here, I'll just point out we're starting to get a kind of a crawling pattern along the 50-day moving average. I'm going to show you roughly the same thing in the minors. I've seen this pattern before. Price kind of bounces, and this can be a moving average or it can be a trend line, whatever, but it kind of bounces. Every time we get down here, the buyers come in and they buy, and they use that as their stop. And typically, especially when price is stretched a long way above the 200-day moving average, usually what happens is that at some point the support doesn't hold, in this case the 50-day moving average, and you'll get a break below it, and then all of the buyers that have been buying that support, they will all start to stop out, and you'll get a violent move down, and usually it doesn't stop until it retraces back to the 200-day moving average. So we've kind of, looks like we've got that starting here in gold, and we've got something very similar happening in the miners, even more blatant here, just continually bouncing off this 50-day moving average, and then on Friday we closed marginally below it. So Monday may be a big day. If we get a strong move down on Monday, something that clearly takes price back below this 50-day moving average, I think then the miners are going to be in jeopardy of this crawling pattern playing out, and at that point I think you better be on the sidelines, because it's probably going to be a vicious and aggressive move back down to test the 200-day moving average. And again, that is actually a good thing. We can wipe out that bullish sentiment that's been built up over the last 4 or 5 months, build the fuel for the next move up, and I think the next intermediate rally will at least test the all-time highs here. And then to finish, I've put the Fibonacci retracements. You can see this has been an incredibly powerful rally, sliced right through the 38% retracement without even hesitating. Same thing with the 50, made it all the way to the 62% Fibonacci retracement, and that's kind of where we ran into that brick wall, and now we're churning sideways, and you can see it on this chart as well. way too much space between price here and the 200-day moving average here. We're either going to have to go sideways for a long time, or we're going to have to come back down and close some of this space, reset sentiment, and that'll build the fuel, I think, to for the next intermediate rally to possibly test these all-time highs. But at this point, I think it's I think it's overly optimistic to think that this is just going to just keep going and going and going and stretching further and further above this long-term moving average, unless you are convinced that we've started the bubble phase in gold, and I just think it's way too early for that yet. Maybe during the next intermediate cycle, and maybe it's still several years away, but um, I don't think it's time to just get another huge leg up. Not 26 weeks into an intermediate cycle. I think it's time for either a long sideways consolidation or a kind of a scary pullback to um, close some of this gap. And sorry, I did misspeak. This is not the 200-day moving average; it's the 200-week moving average. But still, um, just I think just too much space between here and here. We need to close some of that. A move back to 35 or even as low as 32, retest this breakout right here would be completely normal and would build the fuel for the next leg up.